The following content is meant purely for educational and informational purposes and should not be relied upon as financial, investment, legal, tax, or any other professional advice. This is the Fundamentals podcast, where we demystify crypto and help you navigate this ever-evolving internet-native economy. In this episode, I'm joined by Kain Warwick, the founder of Synthetix, a derivatives liquidity protocol providing the backbone for derivatives trading in DeFi. To cover the basics, decentralized derivatives exchanges are smart contract-based exchanges that allow users to mint and trade the synthetic versions of different assets globally. On-chain derivatives exchanges bring tokenized representations of all asset classes within the reach of anyone with an internet connection. Synthetix is built on Ethereum and OP Mainnnet. How it works is that synthetic assets and associated products are collateralized by stakers via the SNX token, which when locked in a staking contract enables the issuance of synthetic assets called synths. The pooled collateral model allows users to perform conversions between synths directly with the smart contract, avoiding the need for counterparties. In this episode with Kain, we discuss the initial vision behind Synthetix and how V3 aims to fulfill this goal. We cover the lessons learned along the way, recap the fundamentals of Synthetix's economic model, and discuss the state of revenues, inflation, SNX staking, and maintaining the general health of the protocol. We also speak about how Synthetix is currently positioned within the market and where they see the biggest opportunities. Also, we speak about increasing demand for trading on Synthetix, how the current tech stack will scale, the core contributors behind the project, current growth drivers and challenges, and more. It's pretty late where you are. What's keeping you busy these days? What does your day-to-day look like?
I don't know when this interview is going to come out, but I've got something that's going to be announced in the next few days. I'm working on a new project within the Synthetix ecosystem. So that's what's been keeping me busy most days these days. Okay,
that's a good tease. A new project coming up. Looking forward to that. But yeah, welcome to the Fundamentals podcast. It is great to have you on. We had a good discussion a few months back with some core contributors from Synthetix on covering some basics, and I think this will really build on well to everything coming up with V3, and then also just to do a quick recap of all the fundamentals related to Synthetix, because there's always educating to do there. Now, as this will be a very future-oriented episode, speaking about everything coming up, I thought it would be pretty neat to start with you kind of reminding us about the initial vision behind founding Synthetix, really. So how you define the core problem that you wanted to set out to solve.
Yeah, initially we set out to create a payment network. So, that was called Haven. And then other stablecoins came out, which kind of rendered that less valuable, I suppose, that approach. And so we decided that what our network could enable would be multiple different currencies and multiple different assets, and that we would let people sort of trade between them, right? So it became more like a FX play than a payment network, right? But it still had this idea of moving stablecoins around, tracking value, using oracles, etc. And then having done that, I think we had gold, silver, some other random stuff. And then we added Bitcoin. And as soon as we added Bitcoin, that was when we had the first kind of flash of a bit of product market fit. People really wanted to hold Bitcoin on Ethereum. And at the time, there wasn't really an easy way to do that. We didn't have wrap Bitcoin yet. So, or REN BTC or TBTC or, a lot of these assets. So there was a lot of demand from the early dexes, either Delta, IDEX, to be able to have BTC tracking pairs on Ethereum. And so, we had that, and that kind of created an interesting dynamic, I guess.
Yeah, definitely. And with that vision, I know you've raised several rounds of venture funding along the way as well. How did you translate that vision and the problem you wanted to solve into the venture case? So if you could briefly walk through how that has been pitched throughout the years and maybe how it's changed, if it has.
Yeah, we did an initial ICO where there were a bunch of funds that went in, people like Block Tower, others who went into that original round, but it was an ICO, right? So it was like a pre-sale into sale, public sale, et cetera, et cetera. Then having done that, I think, we had significant funding, obviously, for the first 18 months or something. And I don't think we actually raised any more capital until maybe mid 2019. So, the ICO was early 2018. So it was probably 18 months later we raised a bit of capital. I think we raised from Framework Ventures was one of the first ones. And then Paradigm and a few other people came in. And I think in 2019, when Synthetix started to work and people started to get excited about it, there were a lot of funds that approached us and were interested, but I think one of the problems was, the price had gone from 3 cents to 30 cents over the course of like 3 months. And a lot of them were like, oh, we missed the boat here. I don't want to buy this 10x up from where it is, whatever. And I think there's a lot of bear market PTSD at that time as well. So a bunch of people passed, and then, it went 30 cents to 60 cents to 90 cents to $1.80 or something like that. And so, we saw a lot of unhappy people, I guess, over the following year. We were like, wow, I really had a chance to get that at 30 cents. And I kind of got caught up. They saw the fundamentals, right? This is the irony, right? Like they saw that it made sense, and they're like, okay, I finally get this thing, because a lot of people didn't get what we're trying to do. And then they're like, okay, I get it now, but the price action, I just can't handle that, right? And then the price action just ripped their faces off, over the next year. So one of those times where sticking to fundamentals would have been helpful. But
yeah, for sure. I think there are a lot of times where sticking to fundamentals would help lots of investors, but it's the attention economy. So sometimes it's a bit tricky, unfortunately. But yeah, you said Synthetix really started to work 2019, but I think like one big step from there was then the launch of V2. But now we're at the stage of you launching V3, which will be a pretty significant upgrade to the whole protocol. So I was thinking, before we speak about V3, can you walk me through the main lessons that you learned up until now? So what the kind of shortcomings have been with Synthetix before today that kind of raised the need to revamp with V3?
Look, it's been a rolling lesson, right? We had this idea of enabling people to trade basically any asset via an oracle, right? That was kind of the thesis, I guess. And we had a mechanism which in principle worked, right? But unfortunately, the architecture probably just wasn't up to scratch, right? And so, we'd kind of do something and we test something, and then we'd hit some limit, and we'd be like, okay, like this is the limit. Let's fix that thing. Then we fix that, and then something else would kind of break. And so I think we reached a point probably in early 2020, post the COVID crash, where I think a lot of DeFi projects were like, wow, okay, scaling is a thing now. Like, we need to do this. Like, we'd had all of 2019 where gas prices were low, you could do transactions cheaply, etc. And, there was not that people weren't working on the problem, but I don't think it felt as like existential as it did in 2020, right? All of a sudden we were like 500 Guays, just not viable, right, for anything. So we really need to solve this. And so, it wasn't until we got onto optimism, I would say, where, there was a step change in terms of the throughput of the network and reduced latency. But even then, reducing latency and making things more efficient, we still had issues with oracles. And so then, we eventually had to revamp the oracles and switch the oracle architecture. So it's been this constant improvement, but it does feel like 5 years on, we've finally gotten to a point now with the architecture and infrastructure and everything that has been deployed where the system works. The problem is 5 years of like iterative testing and random directions and this dead end, and then you're like, well, the code's still there, and let's just close the lid on that and pretend it's not there, but it's still there, right? And so it was like, okay, we're at a point where this thing finally works. Right. So now changing it has become so difficult, right? That like a clean slate just makes sense. And then on top of that, I think the improvement in tooling over those 5 years is just incredible, right? The space has gotten much, much more robust. And so even just how you approach problems are, it's very different today than it was back in 2017, 2018. So it's kind of the right time. I think it's one of the curses of having upgradable contracts. If you look at Uniswap every year-ish, let's say, there's a new version, right? And they get to rebuild it with the latest and greatest tech and whatever cool stuff that the community has released, right? Whereas with us, we've got this legacy code where like you kind of can't touch it. It's like very fragile, right? And so now this has been like, okay, you can touch everything. Let's rebuild it from scratch. And so I think that it'll make the next 2 years that much easier, because inevitably we'll discover new stuff and we'll realize that there are improvements that need to be made, but those improvements are going to move much, much faster in the future.
That makes a lot of sense. And I like kind of like deprecating the legacy stack, taking what works and turning it into more streamlined architecture and going with that. That's how things should be done. I remember I used to work in traditional finance before I got into this space, and the amount of legacy tech those companies use in the background, like from the 80s, is just incredible. There's no such thing as just switching a whole banking corporation from V1 to V2.
1960s COBOL code, right? And it's like, it works, right? It does work, but there's a cost to having that much legacy code there. There's a really steep cost. You just can't iterate. Like it's not even whether you want to or not, you just can't. Like you just cannot remove that, right? And re-architecting, re-platforming the entire thing, the risks versus the benefits just never pay off, right? Well, at least the cost-benefit analysis, right, is just don't do it.
Oh yeah, that's true. And like you said, the pace at which the tooling develops in this space right now, it definitely makes sense to kind of revamp that architecture. But how about V3 then? What is it in practice, and how would you say it fulfills that initial vision and goal that you set out to solve when founding Synthetix?
Yeah, so, we talk about how experimental Synthetix is, right? Even back as late as I want to say the middle of last year, right? There was still a question of, do spot markets even make sense for Synthetix, right? We started with spot assets, right? Like SBTC, SE, they're all spot assets, right? They're all a tokenized ERC20 representation of Bitcoin or whatever, right? And then we had some traction with Curve and atomic swaps and facilitating large trades and things like that. The market shifted a little bit and I think we lost some momentum there. And so we were looking at it being like, okay, if all of our focus is on perps and these perpetual products, does it even make sense to have spot tokens in this new system? And I think my perspective was initially no, right? It doesn't make sense, right? But what has happened is the engineers that have been working on it and the product people that have been working on it have really just kept pushing to try and maintain feature parity with V2 and not to deprecate things. And they've eventually worked out a new approach to spot tokens that I think is a much more efficient approach. So it's delta neutral and allows for much more scale. And it means we don't have to lose that value prop potentially, right? Because if the market shifts back again and there's an opportunity to leverage these things, it could be a big deal. So
yeah, got it. So the goal with that is just to be, with the new spot markets, to be on par with centralized, the experience that you have on centralized exchanges. Is that fair?
Yeah. So, holding a derivative is always going to be a different experience than holding the asset itself, right? And there are a lot of people who have spot assets for various reasons. You bought a token in a pre-sale or a seed round or whatever, right? And now you have that token and you want to sell it. So going to a derivative venue is just not going to work there, right? You need a place to actually sell spot tokens. There's a reason why we have spot markets, right? But if we look at a lot of markets, things like gold, et cetera, right? The derivatives, far outweigh the spot market. Obviously, it's different in certain asset classes, but I think in crypto, that's probably the way it's going to go. So there will be people who have spot tokens that they're looking to offload, right? But, the majority of trading is going to happen in derivatives. But at the same time, it's still so early, right? We want to keep as many avenues open. But the issue with spot tokens in the original version in Synthetix V2X is that they're kind of like a loss leader that cannibalizes the perps markets, right? It's like a free version that just doesn't really contribute economically to the protocol. And so I think what has happened is it's been redesigned in a way that they're complementary, where it's you still get the functionality, but it's actually incorporated in a way that it's not actually a kind of sucking the life out of the other aspects of the protocol. It's not like this free service that you're giving where people are kind of sitting on tokens and paying nothing for it, for example, and it's detrimental because it's actually siphoning liquidity from where it could be more useful potentially.
That does make sense. And now spot market, those developments and improvements are very logical. I think another big change that comes with you moving from V2 to V3 is kind of market positioning in the sense of being more and more of liquidity infrastructure for within the space, which is a pretty big kind of positioning shift in terms of what you've been for the past few years. Now, how does that change things, and what kind of challenges do you see with that shift?
So, Synthetix has always been this giant pile of assets, right? Every asset class is just lumped in together, right? And so to provide liquidity for that is kind of an insane prospect, right? It requires a level of degeneracy, which thankfully exists in the space, right? To get people to do that. But, there was always a view that that was not going to be sustainable. It was okay for the bootstrapping phase, but at some point we had to find a way to silo these things, right? And not have a single pool. And so that's one of the big things that I think V3 does is it kind of separates out different assets with different risk profiles so that you can provide liquidity to specific asset classes if you choose. And so if you're someone who wants to build something on Synthetix, you may not want exposure to all those different things, right? You might just want exposure to whatever the specific asset is, or a specific class of assets, or specific markets that you're trading or that you're facilitating trading on. And this silos that for you, right? So you still get the ability to kind of drive a lot of liquidity into them, but you don't have to have exposure to assets you don't want to have exposure to. And so I think from an LP perspective, from someone who's providing liquidity, that's huge. And from an integrated perspective, that's really big as well, because you just want to minimize the risks that you're taking on when you're building on a new platform. And so I think that this does minimize those risks significantly. That doesn't even touch on permissionless assets, right? So, let's say you want to build a derivatives exchange just for commodities and FX, right? And you're going to build a front end that incorporates that and, maybe has some specific features around that. You can do that now without being exposed to crypto. You can just have that and stay in that lane. Great, that's going to be interesting. But we then take it a step further and have permissionless markets where effectively you don't need to be a solidity engineer to engineer a new asset, right? You just need to be a financial engineer. And there's a lot more financial engineers in the world than there are solidity engineers. And so right now, if you have an idea, if you are someone who comes from TradFi and you work in structured products or weird derivatives or whatever, and you're like, why doesn't crypto have X, right? Like why, that asset, like people love that, banks love it, hedge funds and crypto would love this. Like why doesn't someone build it, right? The barriers to entry for building a new asset and getting liquidity into it in crypto are astronomical, right? You need to put together a team, and you need to build the contracts, and maybe you need to tokenize the entire protocol. You need governance, you need all of this stuff just to get to a point where you can do financial engineering, right? That's a heavy lift. And so what Synthetix permissionless markets do is they allow you to create now, and there's been places where you could do this. The problem was you would do it and then you're off by yourself and there's almost no way to attract the liquidity. With Synthetix, you go and build something, you attract a little bit of liquidity, it starts to work, right? And this is very similar to how Uniswap works, right? Like a new asset, people launch a new pool, for whatever reason, starts to get some traction, people like trading that asset or that pair or whatever, starts to get some momentum, and LPs are mercenary. All of a sudden they're like, okay, I'm gonna point some liquidity here. The same thing is gonna happen in Synthetix, where you'll have new permissionless pools and markets that are really interesting in getting some traction, and people will direct liquidity towards them and they'll have the chance to grow. So you have that cold start problem solved to an extent, because there is just liquidity looking for a place to go, right? It knows how to find those places that are new and interesting, right? It's already in the protocol is there. There's a bunch of liquidity just sitting there waiting for something cool and interesting to point at, and you remove all of the stuff that you need to do except for the financial engineering. You construct an oracle, or you construct a system or whatever. You come up with a novel idea of how you're going to put different assets together, and then that's it. You do that part, bang, you're ready to go.
That's going to be a massive unlock, really removing the need for the solidity engineer and opening up the playing field for financial engineers. So moving on, maybe to speak a bit about Synthetix's fundamentals really at a high level, because you can't do enough educating about these things. And you recently published a thread about Can Synthetix Death Spiral. And I know this has been a topic for years, of course, with your model, and especially from the perspective of the relationship between SNX and SUSD. So I was wondering, could you explain, in proper layman's terms, how Synthetix works and that relation between those two tokens? So basically the economic model there.
So, this model was inherited from Haven. The initial idea was you have a token, that token accrues 100% of the fees, revenue, whatever, right? Economic benefit, to be as abstract as possible, right? 100% of the economic benefit of the protocol goes to the token. It doesn't get siphoned off anywhere, it doesn't do anything weird, it doesn't go to a labs entity in the payments or whatever, right? Token holders get 100% of whatever this thing generates. And then you go and set up the rules of a game and you say, this is what the game does. This is how it works. If you do this, you get this, and you get a percentage of the total economic benefit. And then you kind of create this two-sided marketplace where LPs are coming in and they're staking SNX. They're putting up SNX as collateral. And that is facilitating these activities, permissionless, in the future, right? Let's talk about the future. Permissionless markets, right? The spot markets, delta neutral stable coins, perp markets, options, weird and wonderful derivatives. All of that stuff is happening And fees are being generated by people who want to trade these derivatives, right? These assets. And those fees flow into a pool and they're paid out by a very clear set of rules, which is whoever has provided the most collateral gets their pro rata share of the fee revenue, right? And so the value prop of the SNX token is that it is the primary collateral and it is also the asset that collects all the fees. And so, when you look at some other examples, right, like of protocols that have different dynamics, right, where there is maybe a split between LPs and token holders, right? So Uniswap's a good example. LPs in Uniswap, 100% of the economic benefit of Uniswap goes to LPs. 0% goes to uni holders, right? Uni holders just get to play some cool governance games, right? But there's a fee switch, and there's going to be a fee switch in V4, and maybe one day it'll get switched over. Synthetix started from the exact diametrically opposed position, right? There's a fee switch, and it's been welded shut. You cannot move it in the other direction, right? It can't be switched off, it can't be directed elsewhere, and governance is really, really adamant about that. This is how dogmatic this Synthetix community is about protecting this economic benefit going to SNX holders, is that it was only a month ago that we were able to get consensus around sharing some fees with the front ends that are driving the revenue. That's how greedy the SNX holders, they were like, no. I'm not willing to share a fee. Someone's going to come and provide a public good of an interface here for people to trade on this thing. That's my fee revenue, buddy. You can't take that away from me, right? It's just a completely diametrically opposed position, right? To what some of the other protocols have started with, where it's effectively, all the benefits captured by LPs and none goes to token holders and whatever. So I think the fact that we have a system like that, where it's very clear, was really beneficial. The problem was that there was no economic benefit. There was really minimal activity. And so, the SNX token was trading at a PE of 100 trillion, right? For a really long time, right? There was $1 to be shared amongst everyone per year of economic benefit, and the thing's worth $1 billion, right? And on some level, that was right. If you look historically, now it's generating $30 million a year, right? In 3 months' time, it could be generating $100 million a year. And at some point, it needs to, that dial needs to kind of move, right? The interesting thing about V3 is it unwelds the fee switch, if you will. It introduces the idea that maybe there's some other collateral that could be added, and maybe some of the fees or some of the economic benefit of the protocol could go to those LPs. As you can imagine, that is a fairly contentious discussion within the Synthetix community at the moment, because the fee switch has been welded open for a long time, and so to dial it back is going to, it's going to cause some concern for people.
I can definitely imagine that, but I think it makes sense to kind of unweld it maybe at this stage when the protocol matures. So those are discussions that need to be had. Now, I do want to speak about expanding collateral base as well, but I'll get to that soon. Quickly on the thread that you wrote related to maintaining the health of the protocol while you're incentivizing SNX stakers. And the health of the protocol to some extent is directly proportional to the incentives to claim and then the ratio of LPs who claim them. How do you maintain the health of the protocol in this scenario?
Yeah, so, in the early days, it was inflation, right? That was how it worked, right? It was this thing in the future might work, but it's hard to get people out of bed just on a hope, right, of future benefit, right? And so when we launched staking, which is basically SNX LPing, right, back in March of 2019, give or take, we changed the token economics so that all of a sudden there was inflation. The token went from 100 million supply to, I think, circa 260 or something like that, right? And it was going to be paid out over 4 years. And the idea was, okay, well, that gives us 4 years to kind of get our shit together and start generating some actual revenue. And if we haven't done it by then, well, something's wrong, right? Now, 4 years was maybe a little aggressive. I think in the end, it kind of just fell over the line in March of this year, I would argue, right? Where revenue kind of ticked over maybe $1 million a week for the first time or something like that. And so, it was very close, I guess. But the situation now is you have a market cap of circa 600 million and fees, which, go to LPs, right? SNX LPs to the tune of 30 million a year. So that creates a dynamic where I think you put your collateral in as an LP and then you borrow against it, right? And you can borrow 20% of the value of the collateral that you put in. The current fee distribution pays down your debt completely after about 2 years. That's the kind of run rate. So, you imagine you've got, let's say, $1 million worth of SNX and you borrow $200,000 against that SNX. 2 years later, the loan's completely paid off. So in terms of APY, it's like 10% a year or something like that, right? So that's a decent APY paid effectively in stable coins, right? Because you can borrow more against your SNX if you want to, right? Your loan's been paid off and you can then borrow more. But ideally, we need to get that up to, I think, probably 25-30%. And I think that's coming. The way that volume's growing, the way things are going at the moment, I think that will come.
Okay. With this model, one thing that comes to my mind is that the staking model dilutes holders who do not stake, SNX holders who do not stake, right? So is this a conscious design choice to build kind of a holder base or a cap table that consists of mainly active and sophisticated traders, or has this just ended up this way?
The idea was it was very high inflation and we wanted people to stake, right? So it was basically like, look, stake, become an LP or get diluted out. That was what the community was sort of saying, right? The inflation rate now is far lower. It's not 100% a year like it was in the first year. It's down to 5% or something like that. So the inflation is no longer the driver, right? It's actually the fees that are the driver. It's just the fees are probably still a little bit lower than we would like. We'd like the fees to be a little bit higher.
Okay. But still in this case, the ideal rate of SNX staked, from your perspective, would be close to 100. That is conscious design choice.
Yeah. There isn't much utility for SNX just sitting there. Now, that said, right, there is a fair amount of risk to becoming an LP. And so what we are planning to introduce as a test in the next few weeks is a more kind of simple, like what you would typically call staking. Right? Actual just like put the token in the thing and you will get some yield, but you're not taking risk against it. You're not like collateralizing anything. You're not borrowing anything. So we're actually shifting in V3. There will be SNX stakers. They will get a small portion of the fees and maybe some governance rights because we ideally want all SNX to be participating, right? There's always going to be some float of SNX that's sitting on exchanges for market making and, people that are passively holding. But the idea is that we want as much of that SNX being useful as possible.
That makes sense. And you mentioned how staking will be evolving with V3. Was there anything else that is coming with that than what you just mentioned?
There's, I guess a big change in theory might be the introduction of other collaterals that get fees, allowing LPing into different markets and pools of ETH or other assets potentially. And if you want LPs to turn up, you need to pay them something, right? We wouldn't have many Uniswap LPs if 100% of the fees went to uni holders. And so the idea is basically, okay, how do you introduce this in a way that ideally grows the total base, right? Because SNX is currently the constraint in terms of the amount of liquidity in the system. At the moment, there's sufficient liquidity for the kind of liquidity demand, I guess, that exists, in terms of open interest and trading activity and curve pools and things like that. There is actually sufficient liquidity. But you can imagine only a slightly higher demand level and that probably would get tapped out. So working out how to introduce outside collateral without really diluting the value prop of SNX, I think is going to be the challenge for the next 6 to 12 months for the project.
Got it. And with how both SNX staking is evolving and then you also kind of expanding SUSD's collateral base, it seems like you're opening up the field for an expanded user base, just getting to attract more people to contribute to the protocol as LPs and as users as well. So who do you want to be Synthetix's users right now? And what are like the concrete actions you're doing to attract them?
So there's always been two camps, right? There's the staker LP camp. And I think we've had pretty good product market fit on that front for a long time. That's been working, right? We're probably one of the earlier protocols to get product market fit in that respect, that, a bunch of people were willing to go and yield farm and do all the stuff we wanted them to do. Where we've struggled has been on the trading side. As I said, we've had flashes of product market fit in the past. I think we've finally got a perps market where the product market fit is really solid. And so then the question is, okay, product market fit, how do you ramp that up now? What do you do? How do you attract more traders, right? I think we've got sufficient stakers, and I think the incentives are sufficiently there that new stakers and LPs will show up if the fundamentals are there. If the thing's working, people are aware of it, people will kind of come and do it in the same way that they move around different lending protocols and stuff. I think there's fairly sophisticated players that are waiting for the right time for any protocol for the yield to be high enough to jump in and do it. And they know how to do it. I don't think that's going to be a problem. I think the key thing is going to be driving trading activity. If we're driving trading activity and we're getting new traders, that's going to really drive it. And so, that is the question. The $1 million question right now is Synthetix has spent 5 years focusing on the LP side, on the supply side, not on the demand side, right? We have to shift our focus to the demand side for the first time. And can we do it? Are we capable of doing it? Personally, I'm bullish because I think we did it for a harder thing on some level, right? We were able to generate growth and user acquisition and all of that sort of stuff on the supply side, the LP side, which arguably, is harder. It wasn't like there were a ton of existing users or platforms that we could cannibalize users from and kind of pull users from. We had to invent those people. We had to train them and teach them why it was valuable and do all that stuff. Traders are still, even in the bear market, there's a lot of trading activity. There's tens of billions of dollars of perps activity a day. So that market exists. We just have to find a way to attract their attention. And I think we can do that.
Yeah, attracting demand side is it's a process that I'll definitely see evolve over the coming months. But as of today, what assets do you see that Synthetix has a competitive advantage for from a trader's perspective who's looking at all the options out there on the market?
Yeah, that's a good question. So I would say the fundamental problem right now is that because for someone to trade on a perps DEX, right, whether it's DYDX or GMX or Synthetix, right, you need to be sophisticated enough and comfortable enough with on-chain transactions that you can bridge or at least sign transactions on-chain, right? And my sense is that in a bear market, the proportion of people who are comfortable with the tech goes up significantly, right? In a bull market, maybe 1% of people have any idea what they're doing. And 99% of people turned up yesterday. In a bear market, you flush out a lot of those people. Some of them learned, let's say it's 10% right now of people in the space are really comfortable and willing to kind of jump into a DEX and learn how to, transfer and all of that, sign transactions, et cetera, et cetera. Okay. There's an order of magnitude more activity from people who are not comfortable doing that, who have just lived on centralized exchanges forever and that's all they know. And so my view is you need to kind of come to them. Right? They're not going to change their mind. They've lived through an entire cycle or two sitting on Binance, right? If last cycle didn't change their mind and they're still on a centralized exchange, you got to meet them where they live, right? You're going to have to reduce all the friction and do all that stuff. And so let's say you could, right? Let's say you had a front end that removed all of that friction, made it as easy as possible, was as simple to use and sign up for as Binance, Bybit or BitMEX or whoever, right? Now you then start comparing the direct functionality. That's things like how many assets do you have? So Binance has 200 or so perps markets. Right now we've got 40 plus. Right? So, they got 5 times more. I think some of them are different assets or different asset pairs or, margined with different things. So, maybe it's not 200 assets. I haven't looked into it too recently, but there's still a ways to go there to cover the same number of assets. Then you have things like fees, trade execution fees and, skew fees and all that sort of stuff. And I think we're competitive there with most of the centralized exchanges. I think that, Synthetix as a trade execution layer is competitive on a fee basis, right? Maybe the funding rates are still a little bit high, but, fills offset that. The fills are a little bit better in some cases, particularly if you're trading against the grain, if you're a contrarian trader, there's no better place to trade. You're getting much better fills, effectively almost free trading, basically. And so you look at all that stuff and you go, okay, are we ready if we could remove all the friction? And my answer is yes. I think we are ready. I think we're ready to compete. Then you throw in V3, perps V3, cross-margining, a whole bunch of, really cool stuff that make it cheaper and more efficient for a trader, especially bigger traders, more sophisticated traders. It's really hard for centralized exchanges, I think, to compete with that. And then you get into permissionless markets, and now you've got weird stuff that other exchanges don't have. And if you look at the playbook of exchanges, right, over the years, it's really been have every asset. Fees are important. You can't gouge people, right? Funding rates are important. You can't be crazy funding rates, right? But really, it's the asset that drives user acquisition. If you turn up every day to, let's say, Kraken, right, for a long time, and they've got 12 assets, and you've gone into 15 different ICOs and you've got all of these random coins sitting in your wallet and you're trying to work out how to sell them. And then all of a sudden Binance is like, hey, we've listed, Filecoin, and we've listed this and we've listed that. And you're like, I want to sell this. You go to Binance, and then one day you never go back to Kraken. You're just a Binance user. And I think that was the playbook for Binance. It was the playbook for FTX. And it's been the playbook for Uniswap. Because Uniswap as a permissionless exchange is always going to be the first one. It's the first place that has liquidity, right? And so I think Synthetix, once we have permissionless markets, will be very, very fast to list new assets, right? And I think that's going to be a significant driver. And so we're already seeing this. So a great example is Pepe. I think right now Synthetix has like the 4th largest open interest on Pepe perps, because there's a lot of centralized exchanges that just never got around to listing it. And, Pepe will pop back up again in 2 weeks or 3 weeks or a month or whatever. And everyone's going to want to trade it again. And they're going to look and they're going to be like, where is it listed? And it's not going to be listed on, wherever, whichever exchange, right? And so our ability to be responsive to the market, I think, is going to be a huge, huge driver, especially as we get more into a bullish part of the cycle. Because then people's attention span is like that, you lose them real quick.
Yeah, you do. So is it fair to say that you're saying like the primary driver for adoption there, it is always the asset, and the user experience, even though it is freaking important, it's kind of secondary to the assets?
I think if you get to parity, right? Like, I think if you get to, if you look at the top 5 perps centralized exchanges, right? Or perps markets within a CeFi, there's not a huge differentiator in functionality and design and look and feel, right? Like, you got some stuff like BitMEX that looks like it was, designed in the 80s or whatever, but like there really isn't that big of a difference, right? The driver, why there's 10 times more volume on one venue than another is not coming from like design and look and feel and UX and onboarding and all of that sort of stuff. It's really coming from the number of assets and all of that stuff. And then there's additional functionality, right? Like if you only have perps, okay, that was okay for BitMEX for a while, right? Because they were kind of the only place that had perps for a long time, right? And so it was like, well, if you want to trade perps, you go there, right? And it's worth going there because you can't go anywhere else, right? And then as every single centralized exchange listed perps, that kind of eroded. And now you have a situation where BitMEX is kind of annoying because you don't have a spot market to trade in. You just kind of want a one-stop shop where everything's there, right? As soon as you start kind of missing functionality, I think it really hurts you.
And if we look at the broader market, including both decentralized and centralized like exchanges now, there are a lot of like different technical solutions. You have like off-chain order books to solve this, the pros and cons, hybrid models. You have DYDX going with their app chain model, and then you deciding with OP Mainnnet and building there. Are you able to achieve parity in the long run from the user experience and fee side with your current tech stack?
So my thesis is yes, right? There's some stuff you need to do. I think there's some compromises, but I think we have the tech now.
Okay.
We can do it.
Is an optimistic rollups performance enough for the end game of Synthetix when we think of the years to come?
So if you're comparing a database, right, and a trading API in a database or whatever, to Optimism, the latency is higher for sure, right? But in V3 and V3 perps, when you execute a trade, the fill that you get is kind of known at the time of submitting the transaction. And so there's a way to get a front end, for example, to just show you that, like short of the network collapsing, right? In which case, you throw an error or something like that, which happens on centralized exchanges where it's like fill, unfill, sorry, you got, rugged by CZ or whatever, right? Short of that, right? The price is the price. You're going to get that price. And so I think that there are some UX tricks for sure that you can do it. But, if you want to look at responsiveness, like go and look at Optimistic Etherscan. That thing is as responsive as a centralized exchange, right? Like there's ways that you can, if that's your goal, right, and you're optimizing for it, you can do it. It's just that most of the time dApps haven't been optimizing for that. And the reason why we haven't optimized for it at Synthetix has been because we didn't have a good enough execution engine for that to be the differentiator. Really, it was only diehard SNX people that were trading on our venue, because they were already in the ecosystem and they wanted to, test it, make it work, etc. Right? Now, the average user should be able to have as good an experience on a front end that we can build, I think, than, any centralized exchange. It just requires laser focus on that as the goal, right? Being very pragmatic, willing to make some compromises where they're needed for UX, and you can get there for sure. Or close enough that the average user is just really not going to care.
Yeah, I feel like based on like everything we're speaking here, you're kind of moving forward with two approaches, both with the liquidity infrastructure, having Synthetix become sort of a back-end core piece of infrastructure within the decentralized derivatives and perp space, and also really focusing on building more user-facing stuff. So are you progressing both of those at the same time?
How does that make sense?
Yeah, how does it make sense? And are you focusing on one more than the other, or what's going on?
Well, how it makes sense, I think, is you need to convince someone, right, to do the second thing. The core thing's happening, right? Like the core contributors are working on the liquidity engine, right? And they're tuning it up and it's ready to race, right? It's as fast as anything out there. So you just need to find someone who's going to build the other part. And that, there's a large group of people in the community that I think are coming to this conclusion simultaneously. For a long time, people used to say like, why don't you market Synthetix? Like, this is a joke. People come into the Discord and be like, the marketing's so bad. And it's like, you do not advertise a shitty product. That's the worst possible thing you can do. We have a good product. It's LPing. LPing is a good product. It makes sense. It works. We've got product market fit. We're happy to talk about that. We're happy to get people to do that and see the vision, right? Join the network. We absolutely should never have advertised, nor did we, to get people to trade on Synthetix. It just wasn't a good place to trade. It's only been in the last 3 months that it actually is good enough to try and push users to it and not have them just walk away scratching their head being like, what happened to me there, right? And so finally, I think the whole community is kind of caught on in the last, like, we're talking weeks, months maybe, but like weeks, right? That like, holy shit, it's time to get our user acquisition hats on, right? Like, let's get some people using this thing. And so when you start thinking from that perspective, right? And I have been for the last few months, this has been kind of the frustration for me over the years, right? In Discord, when people are like, you guys are the worst marketers in history and blah, whatever. And you kind of have to hold your tongue, right? Because like, if you say the quiet part out loud, like, guys, like, the product's a piece of shit. We can't advertise it, right? Like that, that's not amazing, right? It's like, it's gonna get better, but this is the tech we have. We're rubbing two sticks together, guys. Like, how good could it be, right? Meanwhile, you got CZ with a nuclear power plant over there. Like, we can't compete with the guy, but we're working on it. We'll get there, right? And so I think that if you made that kind of explicit, it would be hard. But on the flip side, I would argue that the Synthetix growth strategy to go from 0 LPs at the start of 2019 to one of the most kind of fastest growing, most interesting projects in the space speaks to our ability to growth hack and to market and to drive interest and excitement and all of those things. It's just we haven't been able to point it in that direction, right? And nor should we. We've just always pointed in this direction. And so now, finally, in the last few weeks, we can actually point it in the other direction. And I think we're ready. I'm certainly ready.
I can imagine that feels good. I can finally confidently speak about the product in the way you want to.
I'm excited to say it's not a piece of shit anymore. It's actually good, right?
Yeah, I feel you. That's good. How about the core team building and contributing to Synthetix right now? If I've understood correctly, I think most of the OG gang behind Synthetix has kind of moved on to other challenges. So I think it would be great if you can kind of walk through how the core contributors to Synthetix have developed and what the composition of everyone contributing now kind of looks like.
Look, there's some days where I look at the core contributors today and I think it's some kind of miracle. Like, I really don't know how it happened, right? And then there's other days where I'm like, no, it makes sense. It's a bunch of super smart people with an incredibly hard problem that were just given free rein to go at it, right? And of course it's going to attract those people, because it's one of the hardest problems in the space with the most uncertainty, right? How do you solve all of these challenges, right? From all the way through the stack, from an architectural thing all the way up, right? And so I kind of go back and forth between it was just the most incredible, random, miraculous luck that we just have 40 amazing people. Like the Synthetix core contributors are insane. The current core contributors, right? I have obviously a lot of love for the OGs, and I'm one of them, right? But we do not hold a candle to that original group of 10 people. Would not be able to compete with the current core contributors. It's just there's a much deeper pool of talent to pull from, and they're exceptional people, and they've been kind of let run in at this problem, right? One of the reasons why a lot of the OGs left, I think, was that 2018 and 2019, I've been in startups for a long time, almost 20 years, half my life. And I've been in some really terrible startup situations, just like diabolical situations. 2018, 2019, Synthetix Haven transition, one of the hardest things that I've ever done in my life. We called it the death march for a reason, right? Like you're just dead. You had no water, no food. You're just walking through the desert and you're like, when will this end, right? Like, how do we kind of end this? And so I think the people who made it to the end of that just kind of fell back into, the real world and they're like, I'm done. I can't do anymore. But it's interesting because even some of the OGs are starting to float back in. The other day I saw a couple of OGs, people have had a year off or whatever to just like recover and recuperate, and they're starting to get a bit of interest. So we might see some of the OGs come back, but at the moment the core contributors that we have now are just insane.
Yeah, that's a good sign with the OGs coming back, and I feel that it's a very like harmonious situation to be in, where you notice that the group of core contributors are pushing things forward in a way that you couldn't, as like the founding team, ever do that. That's where a project has reached a certain stage where it has matured. It's I can imagine it's an amazing feeling. Now, speaking about like OGs, I think it was a few weeks back, I was speaking to Rune at Maker to go through kind of the end game plan, and the ending was, here's this massive plan, here's everything that needs to be done, but I can't wait to go lay under a palm tree and just like have this DAO actually autonomously run without me. What's your view on kind of this whole thing? Because you've been grinding away for quite some time around Synthetix. How do you view your role developing?
Yeah, so I've dipped in and out though, right? Like, there's been periods where I've just done governance, like that's it, right? Like I've done no day-to-day stuff at all. It's just been like Spartan Council. And being on the Spartan Council, if you do it seriously, is a job. It's a whole job, right? So there's been times where that was just my job. There's been times where, I was doing more like facilitation and mentorship and, working with CCs and trying to, help them to understand context and, how I think about things, etc. And now I'm back in more of an operational role, I would say, doing more project management and more of the stuff that I like because I'm working on this new project, but it's independent of Synthetix, like proper, right? Like the Synthetix core contributors working on the protocol. What I'm working on is kind of, something that's just off to the side a little bit. It still uses Synthetix and it's going to be, I think, an important part of it, but I'm back to day to day. I took 6-7 months off from November of last year through until late October last year through until probably April this year, and just worked out, went running, got fit, got my head back together-ish. It's never going to be fully back together, but got myself in a good place mentally, and once I got to that place, I was like, all right, now I'm ready to do something again. I just wasn't in a place, last year. By the time I got to last year, I was just not there mentally. So
glad to hear you were able to take a break. I'm feeling better now as well. It's so powerful to be able to find that kind of mental clarity after a period of just confusion. It becomes weird sometimes. I want to move on to speak just quickly about financials for how it relates to kind of V3 and the new updates there. You have been pretty clear about the fact that fees with a protocol like this are the main indicator of success, and like more revenue needs to be the goal. I agree with you 100%. What's the current state of fees and revenue on Synthetix in terms of the new fees that you're introducing as well with like V3, and how do you see those affecting the intrinsic value creation for SNX?
So, I kind of go back to that same comment earlier of like, there is an existing market, right? There's, tens of billions, let's call it 50 billion a day, right? Of perps trading volume, with various different fee schedules, right? In different venues, but it kind of boils down to like, I don't know, let's call it like 7 bips or 8 bips or something like that, right? That charge. So, that's the pool of fees that the market's willing to pay right now. There's that whole pie right now is probably as big as it's going to get, until we get back into a bullish environment, right? But that's enough. And obviously, you don't play those games of like, oh, if we only get 10% of the total market, but like there's a big pool, right? The goal is just to go out and get as much of it as you can. And crypto, trading venues and exchanges have a way of just getting a level of traction, I think because of the connectivity in the space, that is kind of insane, right? Like, I remember in 2017, people were like, no one's going to take down, Coinbase and Polo and, whatever, right? Like, whoever people were using, Bitfinex, whatever, right? And then Binance just came out of nowhere and just chopped them all up, right? Completely. And people were like, there's, we've got all the exchanges we'll ever need, right? And then this cycle, people were like, all right, but no one can take on Binance. They've captured the market. It's over. They've got everything, blah, blah, blah. And then FTX comes out of nowhere. FTX, maybe you want to put an asterisk next to their record, right? But they did some stuff, right, and it worked. And so my view is that when you get that new influx of users, you don't really know who's going to win, right? But in the short term, the goal is capture as much of the existing volume and existing fee revenue that's there, and that's tens of millions of dollars a day. There's a ton. It's not like you're talking about a market that has $1 million worth of fees a day and you're trying to carve it up amongst 50 of you. It's tens of millions of dollars a day in fees. And Synthetix at the moment is doing $500K to $1 million a week, right? There's nothing at all saying that we can't get to $1 million a day or more, right? And that would just be a huge shift in terms of the dynamic, and awareness of the protocol, and that would really, and we're seeing it at the edges, right? On the periphery, we're seeing it. The fact that we've got the fourth highest open interest on Pepe, which is a less efficient, less competitive market, right? But on the periphery, we're starting to make some inroads, right? And so if we can start to do that as you get up to higher cap assets, and start to chip away and have, the most interest on Litecoin, let's say, who knows, right? Or have top 5 open interest on Cardano or whatever, right? Then, okay, people are going to start taking notice of that. It's going to become a thing. And, right now, I think the calculation I did and that, and no one really said my calculations are wrong, so I assume they're close-ish, right? The PE is 15 or 20. It's, it was $1 billion for most of the existence of the protocol, right? We were trading at $1 billion, times earnings, right? And now it's 20. It's okay, well, hang on a second. Let's really think about that. One of those is definitely off, but one of those is probably also a little bit off as well. The other one's probably not right either, so.
Yeah, could be. I think the math was correct on the thread, at least based on what I read there. And it is true, the PEs have changed a lot. This bear market has kind of fixed those valuation multiples as well, so they can a bit more confidently be used to value things. But we have more cash flow, as well. It's a PS and PE are pointless metrics when you don't have cash flow. It's take Uber in the first 2 years. A PE metric just looks horrible. It's the same with Ethereum's early times. But now if you take the fee burn and use it to calculate the price to sales ratio, it's starting to look much smarter. It's growth stage companies, still a bit high, but we're getting there. More cash flow. Outside of revenue, what are the key metrics and KPIs would you say, or would you kind of guide investors to look at when you think of derivatives DEX?
I think open interest is a really important metric, right? Particularly for Synthetix, because open interest should, the one thing we haven't talked about, right, is the difference between Synthetix perps and traditional perps, right? Because we have an Oracle price that, is the price. That's the canonical price, right? We don't let that price drift based on supply and demand, right? And buy and sell pressure. We keep that price stable in mid-market. And then what we do is, depending on the skew, you pay funding and, there's basically lower fees, right? So we try and keep the market as neutral as possible. And the reason for that is that SNX LPs are the counterparties to the trades, right? So in an ideal world, what you want is $20 billion of open interest that is perfectly balanced. And what you'll end up having is probably $19 billion that's perfectly balanced. And then on any given day, there's $1 billion of froth at the top that kind of, moves around up and down as people exit and open trades and what have you, right? But the end result is that you don't really care which direction the market goes in, right? The LPs are fine. They're capturing fees and capturing some funding from position opening and closing, and you're fine. So I think the really critical metric right now is open interest. And the other thing is open interest is not incentivized. So there's been a lot of conversations about, oh yeah, but OP incentives and blah, blah, blah. And it's well, DYDX has been doing incentives for, 100 years at this point, right? Incentives actually do work. They can have compounding returns and they can, be profitable, because traders will come and try a thing and then realize that it's good if it's good. Incentives are worthless if the thing is a piece of shit, So you throw incentives at something that doesn't work and people will still farm those incentives, but they'll go away as soon as they disappear. But if you've got a good thing, incentives can be really powerful. And so my view is that looking at open interest is a really good indicator. And that's just been slowly ratcheting up over the last like couple of months, right? And also open interest is a critical number for us because as we get closer to the open interest kind of maximum that we can handle, right? On some of these markets, we need to shift them up, right? And each time we shift them up, that's just excess capacity that we're kind of allowing in the market and higher fees in the future. And so looking at the open interest caps and the current open interest is a really powerful indicator of growth, like actual organic growth.
Yeah, that makes a lot of sense. I actually want to go back to the previous point where we spoke about the price to earnings, which I said that yes, calculations are correct, but I just wanted to clarify, like on token terminal side, we actually use two different valuation multiples. We use price to fees, where we take the market cap relation to total fees generated, and then we also have we use price to sales instead of like price to earnings metric because we don't have operational expenses on chain yet for all protocols, so it's like hard to get the direct price to earnings. So with the price to sales, that was like equal to your calculations with PE, and we actually also have an earnings metric on all our dashboards where we use revenue minus token incentives. So in like Synthetix's case is token inflation. And I just wanted to ask on whether you agree with that methodology in terms of token inflation being an expense for a protocol.
I don't believe that it's an expense for Synthetix because it's circular, right? Like, it doesn't actually leave the protocol. Like what it does is shifts the percentage of the network that's owned by different participants, but it's not actually leaving, right? If we were doing token inflation and using it to pay out trading incentives, 100%. I would say absolutely that's a cost and should be deducted from there. But when the incentives are just there to keep the people that are already there in there, I don't believe it's a cost. Now, there's a second sort of question, right? Is like we have genuine inflation. Like it comes out of nowhere, right? Like it's minted. It's not, there's 90% of the tokens are held in the DAO, and the DAO's, so, that's inflation as well, right? Because in a traditional company, it doesn't just have a few 100 million shares sitting there, right? Like it issues shares as like it creates them as they're put out at the market, right? It doesn't just sit on them and trade them or borrow against them or whatever, right? And so, Synthetix and a lot of DAOs are weird, right? Because they hold the whole supply and what's held back is kind of not really in the market. So the reason why I adjusted my calculation in that thread is because I'm basically saying that the treasuries tokens, right, if you assume they're almost unissued, right, but they're still capturing some of the economic value, you subtract that value that they're capturing because that's what's paying for the protocol to exist, then you don't even need, like, it's capturing more value than it's spending, right? Like it's actually accumulating cash. But if you just ignore that and just pretend like it's fully a cost, right? Then all of a sudden you actually do have a more accurate metric. And I don't think you need to deduct the inflation from that, I would say, unless the inflation was being paid out to exogenous incentives that weren't being kept, right? It's almost like you're doing like a continuous stock split every week, right? It's just that the stock split only goes to people that you like.
Yeah, I mean, the reason I ask is because, we're always iterating. We're early in the stage of trying to build comparable financial dashboards for investors to be able to compare different.
And look, it's a clusterfuck, and I think you guys do a really good job, right? Like it's not an easy task you've taken on for yourselves, right? So, I think like people are always going to have, even in TradFi, with like very, like people have like non-GAAP accounting for a reason, right? Because they want to make up their own numbers, right? They don't like the way that the numbers come out in the real ones, and so they come up with all kinds of crazy shit, right? Crypto is, 10 times worse. So you're always like, I think there is some benefit in just saying like, this is the rule, right? And if you don't like the rule, if you don't like the fact that we're, counting your inflation as a cost, stop inflating the token, right? Like we could do that too. Like that's an option as well, right? And we will eventually, we'll eventually cut out inflation. It won't make sense to have inflation when the fees are sufficiently high. I think we probably are there anyway, but it is what it is.
Yeah, that's great. But this is also like a super valuable qualitative context, and why we do these podcasts is because we have the metrics on our dashboard, we have the methodology which anyone can compare, but then they also need to, of course, project by project, understand how it should be viewed from the perspective of that protocol. So if you take the time to dig into it and listen to that section that we just spoke about, then it becomes pretty clear on how it should be viewed.
But I'm not one of the people that's saying like, token terminal is calculating it wrong, right? I'm like, I think it's fine. Like, I'm okay with that.
That's good to hear. Final question. We covered a lot of ground here. There's a lot of exciting things coming up, and also the project that you are working on in a bit stealth yet. Don't know when it's gonna launch. But what do you see as the biggest opportunities for Synthetix in the coming years?
I think the thing that I'm most excited about is the white swan aspect of permissionless markets. Uniswap is just such a great example of this, right? Like how much crazy stuff, not all of it good, but like just the extent of the crazy stuff that was built on Uniswap, and just because the markets were permissionless, right? And like they weren't even that permissionless. They were very constrained in what you could do, but people still found a way to jam weird stuff in there. Synthetix is going to be, much more expressive, right? In what it can do. So I think that like all it takes is one or two super interesting things that come out of that people are really excited about, and the focus really shifts onto the protocol in a very powerful way. And so I don't even have a sense of what that might be. I just think the potential is there. So that's one thing. I think the other thing is we have been trying to build a competitive exchange for a long time, and we're finally there. The exchange is competitive. The execution engine is competitive. It's just the other stuff, the ancillary stuff is not there. And so now it's about bridging the gap. And I think that when people start trading, like one of my portfolio companies, I was talking to them today, and he was like, man, like I've started trading on Quanta. Like what? Why didn't you tell me about this? Like this is crazy. And I'm like, dude, it only was good like 2 minutes ago. Don't worry. You didn't miss anything. And so like, but he was just like, wow, like this is like, so good. Like I'm trading on it all the time. I want to trade there. I'm like going back. I find myself going back there more and more. And I'm like, yeah, like that's it, right? Like that's the thing, right? And so I think that is what I'm really excited about, is that we actually have a good product. We have, we're starting to get product market fit on the demand side, not just the supply side. And if you have both, if you have product market fit on a two-sided marketplace, those things can really get away from you pretty quick.
For sure. That does sound super exciting, and I'm really looking forward to seeing how everything plays out, especially as you start rolling out V3 even further. Thank you so much for this overview. I think there's a lot of insightful context to everything going on at Synthetix. I really appreciate your time, Kain. Thank you.
Yeah, awesome. My pleasure. Thanks for having me.